Hey everyone, welcome to another episode of ADMAIL. This is Bergman, founder and CEO of IRA Financial. I'm here to help you find the answers to the most frequently asked questions from my clients about self-directed retirement accounts. If you want to learn more, you can subscribe to our YouTube channel and follow us on social media. Just search IRA Financial. Hey everyone! Welcome to another episode of ADMAIL. First episode of 2023. So I hope everyone had a wonderful New Year's and happy, healthy, and prosperous 23. I look forward to a great year, and I appreciate you spending some time with me today in 2023. So without further ado, let's get into today's podcast. And I got three great questions for you from three super smart people. One about a simple IRA, another about 72T distributions in a 401k, and the third about setting up a self-directed IRA if you do not live in the United States. So well-rounded episode for you today, and first one in 23. So we're going to make it a good one. Let's get started. Question number one comes from Luke K of Ontario, California. And Luke wants to know, can I still make a simple IRA contribution in 23 for 2022? Well, the good news, Luke, is if you're listening to this or watching this and it's before January 30th, the answer is yes. Because simple IRAs have some quirky rules where for 2022, the contribution max $14,000. And you can do that all the way up until January 30th for 2022. So you have a 30-day kind of lag. Whereas traditional Roth IRA, you'd have until April 15th. A SEP IRA, you technically have until you file the tax return associated with that business. So it's kind of in the middle, whereas a 401k, generally it's a 1231 rule. So if you work at Tesla or Apple and the deferrals get pulled from your paycheck by payroll, generally, the employee deferral for 2022, which is $20,500 or $27,000, that has to be done by 12/31. So here you get 30 or so extra days, including the catch-up of $3,000 for 2022. So hope that answered your question, Luke. That's the answer. You get an extra 30-day window to make contributions for 2022 up until January 30th. Second question is from Jenny T of Naperville, Illinois. Jenny wants to know, if I have a solo K, can I take a 72T distribution? Well, getting super technical here, Jenny. Well, 72T is essentially a substantial equal periodic payment. And essentially what that is it's done for people that are under the age of 59 and a half that need to access some of their retirement account and looking for an efficient way to do that. So what the 72T distribution does, or the substantial equal periodic payment, same thing. So it lets you take money out either till 59 and a half or 5 years, whatever's less. The problem is you can take out only a set amount, which is based off your value of your IRA or 401k and your age, and goes into this table, and it gives you a percentage or the number you can take out each year. You can't go above that. That's the problem. That has to be the number. If you satisfy the 72T distribution rules, you pull the money out subject to tax, but you don't pay the 10% early distribution penalty, which is cool. The problem is it's really only good for IRAs, because for 401ks, you have to leave service. So to do a 72T distribution in a 401k, you basically have to leave your job, which means you can just move it to an IRA and do the 72T from the IRA, technically. And again, it's 5 years or 59 and a half, and it's only a set percentage. So let's say you just needed like a one-time amount of 10K. You may not be able to do it because it's going to be over a period of years, and you may not be able to take that lump sum. So it works for some, generally doesn't work for most. So generally 72Ts or substantially equal periodic payments, mostly done in IRAs. It generally does not work in solo Ks. Why? Because if you leave your job, generally there's no one else to run the business. So you just close the plan and move it to an IRA. So generally doesn't work where you keep the solo K and you're able to do a 72T, because you need to terminate employment. And if you terminate employment, generally in a one-person business, there's no more business. And since most solo 401ks, small businesses, sole proprietors, where there's only one person, It's really an IRA thing, which helps. You get to pull some money out without a 10% penalty if you're under 59.5, but you are limited on what you can pull out, and it's a set amount. So it doesn't always work, but good question, Jenny. Super appreciate it. And third and final question of today's podcast, coming from the UK, Birmingham, UK, James S. I live in the UK, but used to work in the USA under a visa. I don't have a US address any longer. Can I still open a self-directed IRA for a rollover? So the answer is yeah. All you need, I assume if you work in the United States, you have a social security number, which everyone needs in order to work US. I was born in Canada, went to law school in New York. And when I did a summer associate position, I had a social. So I was able to work in the United States, even though I was a student. So when I contributed money to the 401k, even after I graduated law school, I was still under a Canadian visa. I did not have a green card, did not have citizenship. So technically I have 401k. So if I decide to move back to Canada, I would still have the social. I wouldn't have an address any longer, just like James, but I still would need my IRA funds to be invested, or my former 401k funds to be invested. So that's the way it works. So the answer, yeah, James, as long as you have a social, you don't need an address in the US. You can use your UK address. Just need a social, copy your passport, and you're good to go. And then you can do a rollover into IRA Financial, into an IRA, invest it as you see fit. And you don't need to have a current address. You don't need to have a green card or a US passport. All you need is a social. And so assuming you had a social at some point because you worked in the United States, you would be able to use that social as well, James. So great question. I actually get that a lot. There's a lot of folks, whether they're Canadians from India, UK, France, wherever, they worked in the US for a couple of years, they went back home, they got a bunch of money in the retirement account. They're like, hey, might as well invest it. Can't really touch it till I'm 59.5. Don't want to pay the tax. There's not a lot of reciprocity between US and foreign pension plans. Like for example, Canada, which I know, I was born there. Didn't go to law school there, but I kind of understand the rules somewhat. They have an RSP, which is like an IRA 401k. You're not able to roll an IRA into a Canadian RSP. So you got to keep it invested in the US. And then when you're over 59.5, I guess just pay tax, file a US tax return, and then you can use it in Canada or wherever you see fit. So it gets a little clumsy if you want to kind of use those funds. So the best way to do it is keep it in an IRA until you're 59.5, and then you can get the money out without penalty. And all you need is your social. So not a big deal. Your US social, I should say. Otherwise, great episode. First episode of the year. Looking forward to an amazing 2023. If you're watching on YouTube, please give me a like. You can also drop a comment or a question. I do my best to answer every question within a respectable amount of time. Trust me, I'm answering questions all the time. I like it. So I learn from you. You guys learn from me. It's a lot of reciprocity. It's a great exercise where we both benefit from each other. If you're listening to this podcast, really appreciate it. Don't forget to subscribe so you can kind of get the podcast automatically uploaded or at least notified when this podcast drops, which drops every Thursday. And honestly, full disclosure, it's one of my favorite ones because it's a great way to kind of interact with so many self-directed retirement smart people out there that just want to learn, and I want to learn from you guys too. So keep the questions coming. You can send them to info@IRA Financial, just say ADMAIL or Ask Adam. Drop them on YouTube or wherever you can. You can email them, as I mentioned, info@IRA Financial, and they will get to me. So appreciate you guys spending some time with me today and listen to me. I know you probably have some better stuff to do now that 23 started and everyone's getting ready to hit the gym or New Year's resolutions, but this should be a New Year's resolution. Continue saving for your retirement. If you haven't, start. If you have, good job, and keep it going. Just start, stay consistent. Even if 23 turns out to be a kind of rough year economically, investment-wise, put a little money in, whether it's $100, $500, just something. Keep your habits, your good habits flowing, and trust the process. Just trust it. It's based off math. It will work. You will have a lot more money in 8, 16, 24 years than you do today. Just trust the process. You will thank me. And I expect a nice bottle of wine. 20, 30 years when you have a lot of money in there and you're like, hey, That guy, Adam, I listened to him like 15, 20, 30 years ago. And now look at all the money I have just by saving a little bit each week. And all that money just compounded. And now it's real money that I can do some real significant stuff for me and my family. And that's the name of the game. That's why the retirement system works. That's why there's bipartisan support from Dems, Republican. It's the only program that Democrats and Republicans could agree on. Why? It's based off math. Can't screw it up. Deferral, compounding returns work. Start early, keep it going, trust the process. You'll be super happy. So there's a New Year's resolution. Save for your retirement. The government's not going to do it for you. You all got to do it. We all got to do it. So there you go. That's my words of wisdom for 23. And I'm going to keep harping on that for the next 51 weeks. So have a great day. Thanks again for spending some time with me today, and take care.